What if I told you there's a company really positioning itself to redefine modern marketing using AI, all the cutting edge tech? But maybe, just maybe, its stock is flying under the radar. Today, we're taking a deep dive into Stagwell Inc. They call themselves a challenger network. Big growth ambitions, definitely. But also some, well, intriguing financial complexities we need to unpack. Stick around and you'll get a much clearer picture. Is this digital first powerhouse a hidden gem, or do the challenges outweigh the advantages right now? Welcome to Deep Dive. Our mission today dissects Stagwell Inc. Trades on NASDAQ, ticker STGW, currently priced around $5.67. That's as of August 5th, 2025. We're going to look at their business model, the leadership, financials, market position, and try to figure out its intrinsic value, like a value investor would. Think of this as your shortcut to getting properly informed on this pretty fascinating company. Oh, and a quick note for you. Stagwell just released Q2 2025 earnings. That was July 31st. Wall Street's already looking ahead to Q3. They're expecting EPS of about 0.25, revenues around $747 million.
And don't worry, we'll be covering their future earnings literally within minutes of them dropping, so definitely stay tuned for those updates. Before we really dive in, though, please do us a quick favor. Like and subscribe to Stock Analytics AI on YouTube. If you become a member, it's just €4.99 a month. You get priority on the deep dives we do. We're planning to cover all the S&P 500 stocks over the next few months, and members get first dibs. Or if there's a specific stock you want covered sooner, just drop us a super jock. Thanks. All right, let's get into it. Can Stagwell Inc., this challenger network, really transform marketing and deliver sustained value for investors, especially in this fast-changing digital world? We'll start by understanding the basics, the foundation of the company.
Business understanding.
That really is the core question, isn't it? And yeah, understanding the foundation is key. So Stagwell Inc., it's a global marketing and communications company. Their whole focus is transforming marketing for, well, the digital economy we're in now. They help clients with creative stuff, media buying, tech implementation, digital platforms, the whole package, really.
So they're like a one-stop shop for modern brands.
Kinda, yeah. They operate through this network of agencies, mainly U.S., but also in like 45 plus countries. They reported $2.7 billion in revenue for fiscal 22. Pretty substantial. And they break it down into three segments: integrated agencies, their media network, and the communications network.
And their services seem quite broad, more than just ads, right?
Oh, yeah, definitely. Digital transformation is a huge piece, helping clients rethink their business digitally. And that part's growing fast, 12% year over year in Q2 25 revenue. That's actually beating the industry average.
That's a good sign.
It is. They also have the Harris Poll, their global polling arm. Covers 12 countries, millions of respondents weekly. So lots of data insights.
Okay, but you mentioned something, the Stagwell Marketing Cloud. That sounds like the really interesting part.
Yes, absolutely. This is their proprietary software as a service suite, a SaaS platform. It includes AI tools like Harris Quest Brand, Profit Earn, tools for brand tracking, and PR prediction.
And SaaS means recurring revenue, higher margins.
Exactly. And get this, it accounted for 52%, over half of their total Q2 2025 revenue.
Wow.
Yeah, that's huge. It shows a real shift from just traditional agency work. Plus, they do global media, public affairs, scaled creative, lots of different pieces.
Okay, so they call themselves a challenger network, trying to disrupt things. But how big is this challenger, really?
They're pretty significant. Over 13,000 employees globally, and importantly, over 12,250 engineers.
Engineers in a marketing company.
Yeah, that tells you a lot about their tech focus, right? They're in 34 plus countries, 70 plus agency partners, and they figure their addressable market is north of $120 billion. Plus, they've got the industry creds 427 Cannes Lion Awards. That's like the Oscars for advertising.
So, boiling it down, what's their main pitch? Their value proposition?
Their formula is creative plus connected effective. That's their tagline.
Okay, break that down.
So creative is the ideas, the culture-moving stuff from those 13,000 people. Connected is the tech side, the leading-edge tech. Those 12,250 engineers making workflows agile. And effective is about results, performance measurement, research, data insights like from the Harris Poll.
So it's an integrated approach, trying to solve the fragmentation problem for clients.
Precisely. The goal is a holistic solution that makes clients stick around longer, more partnership, less project work.
And what about the industry they're playing in? It's changing fast, right?
Oh, profoundly. Everything's going digital first. AI is everywhere, automating tasks, trying to make ads hyper-relevant, helping with decisions. You also see brand-led marketing making a comeback, especially with Gen Z and millennials wanting brands that align with their values. Niche influencers are big too.
And the money's following digital.
Yep. Global ad spend set to grow maybe 5–6% in 2025. Digital share, almost 70%. And algorithmic AI-driven ad spend could hit nearly 80% by 2027. Stagwell's definitely in a shifting landscape.
Who are they up against? The usual suspects.
It's super competitive, yeah.
Yeah.
And fragmented. You've got the big legacy players, Omnicom, IPG, WPP, Publicis, but also the big consultancies are muscling in Accenture, Deloitte, plus tech platforms themselves, and tons of smaller independent agencies.
So being digital first isn't just a choice, it's survival.
Absolutely. And then there's the regulatory stuff for 2025. Stricter privacy laws like CPRA in California that makes using data trickier, antitrust looking at big tech, false advertising lawsuits, and the need for AI rules around bias and security. Stagwell having a formal compliance program and a risk and reputation unit could actually be a real asset there, helping them navigate that complexity. And, even though it seems fragmented, the barriers to entry are actually getting higher. Well, the tech needed AI. Cloud platforms cost serious money. Plus, building those deep client relationships takes time. That tends to favor the bigger networks like Stagwell, who already have the blue-chip clients and are winning new business.
Okay, so what's their real competitive edge then?
Well, brand strength is part of it. That challenger network identity, culture-moving creativity, the awards, it builds a certain image.
But is that enough against giants like WPP?
Maybe not on its own.
Oh.
But their cost advantages and scale are tangible. They've already cut $65 million in costs since 2021. And they're aiming for another $80 to $100 million in savings using AI by the end of 2026.
How are they doing that?
A big piece is the Stagwell Media Platform, the SMP, launched in July 25. It centralizes their media buying, gives them more clout. That should help margins.
And what about locking clients in? You mentioned stickiness.
Right. It's not a pure network effect like, say, a social media platform, but their global network, and especially that proprietary marketing cloud. They create indirect network effects. Once a client integrates deeply with their tech and services, it becomes harder and more costly to switch. That leads to stickier clients, more predictable revenue.
And you see evidence of that.
Yeah, they reported 26% growth among their top 25 customers. That suggests the model is working to deepen relationships. Plus, they're unique assets. The digital-first DNA, those 1,250 engineers, the marketing cloud driving half the revenue, the Harris poll data. And you can't discount Mark Penn's background either. That's pretty unique.
Okay, we've got a good handle on the business side. Let's talk about the people running the show. Who's leading Stagwell?
Management evaluation.
The top guy is Mark Penn, chairman and CEO. He's got a long career, like 4 decades, in strategy. He advised President Clinton, helped Microsoft during their big antitrust case back in the day. He was the architect of the Stagwell MDC Partners merger.
And he's in pollster originally, right?
Yeah, a very well-known one. Famously identified the soccer mom voter demographic in '96. So deep understanding of public opinion and messaging. They've also made some key hires recently. Ryan Green, a CFO, he's the one driving those cost savings, aiming for the AI efficiencies. Jason Reed, CSO, handled over 50 M&A deals. Niels Laurenberg, CIO, also heavily involved in M&A.
So a seasoned team. Looks like a mix of strategy and getting things done operationally.
Exactly. That combination is pretty crucial for investor confidence,
You mentioned ethics earlier, too. How seriously does it seem to take that?
They talk about it a lot, emphasize ethical and proper business conduct. They've got a formal compliance program, code of conduct, whistleblower policy. They even set up that risk and reputation unit to help clients navigate tricky political situations.
Which is interesting. In today's climate, having a strong ethical compass, or at least appearing to, could be a real differentiator, couldn't it?
Yeah.
Especially with data privacy concerns.
Yeah, definitely could build trust, yeah.
How are they using their capital? Where are the investments going?
They have this framework called DIGIS, stands for Digital, Integrated, Global, Strategic, that guides their organic growth and margin goals. Lots of investment in AI, obviously. And they've been very aggressive with M&A. 33 acquisitions total, 21 just in the last 5 years, mostly marketing companies. Recent ones include ADK Group, Jet Fuel.
M&A fuels growth, but integration is always the tricky part, right? That's a risk for investors to watch.
Absolutely. Assessing how well they integrate those acquisitions and actually unlock value is key. They're also buying back shares quite actively, almost 10 million shares in Q2 25 alone, part of a $375 million program.
That usually signals management thinks the stock's cheap.
Right. But on the flip side, no regular dividends since 2016, so it's clearly a growth story they're telling, not an income one.
And what about return on invested capital? How efficiently are they using that money?
The ROIC was 5.77% as of March 2025. It's fluctuated a bit.
5.77%. That's okay, but not amazing.
It's positive, which is good, but yeah, not exceptionally high. For a company investing so much, especially in tech and AI, you'd hope to see that number climb higher over time as those investments pay off. It's definitely something for you to monitor.
Okay, business management. Let's dive into the numbers now. Time for the financial checkup.
Financial analysis.
All right, key metrics. Market cap around $1.48 billion as of early August 25. How's revenue looking?
Pretty consistent growth trends. Q2 25 GAAP revenue was $707 million, up 5% year over year. Net revenue, which they also report, was $598 million, up 8%. Full year 2024 revenue was $2.84 billion, up 12% from the year before.
Okay, but I see year-to-date GAAP growth is slower, only 1%.
Yeah, that's an important nuance. They mentioned it's partly due to cyclical advocacy revenue being lower because it's an off year politically. So you need to look past that cycle and see the underlying digital growth, which seems stronger.
Right. What about profits? Margin.
This is where it gets interesting. A bit of a mixed picture. Adjusted EBITDA margins look pretty healthy, 16% in Q2 25, 18% for all of 2024, but persistent GAAP net losses. They lost $5 million on a GAAP basis in Q2, $8 million year to date.
So what's the disconnect? Adjusted good, GAAP bad.
That's the fascinating part, yeah. The GAAP suggests significant non-operating expenses or maybe non-cash charges. Things like amortization from all those acquisitions, maybe high interest expenses on their debt, those ongoing cloud investments they talk about.
So for you as an investor, figuring out why there's that gap is crucial. Is it temporary investment or ongoing cost dragging down real profit?
Exactly. Seeing a clear path to sustainable GAAP profitability is really essential here.
What about cash flow? Sometimes that tells a better story than reported earnings.
And here the news is actually quite good. They're targeting over 45% free cash flow conversion for 2025, and the improvement is dramatic. Year-to-date Q2 25, net cash from operating activities was positive $55 million.
Compared to
being negative the same period last year, it's a $122 million positive swing. Calculated free cash flow year-to-date is about $181 million.
Wow, okay. So even with GAAP losses, they are generating significant cash. That's encouraging. Shows operational efficiency might be improving.
It's a very positive sign, yeah. Especially for a company reporting those GAAP losses. Shows better working capital management, too.
Let's talk stability. Are earnings reliable? What about debt?
Earnings consistency, not so much. Adjusted EPS missed what analysts expected in 3 of the last 4 quarters. And those ongoing GAAP losses mean, a higher risk profile if you want predictability.
And the debt?
Debt to equity ratio is relatively high, around 1.88 to 1.92. They acknowledge they use a lot of debt. But crucially, management is actively trying to fix this. They have a goal to get net leverage down into the 2s by year-end 2025. It was 3.18x in Q2, so that's a significant target.
That's important. What about short-term liquidity?
The current ratio is 0.86 as of June. That's below 1.0, which can sometimes signal potential short-term cash tightness, something to keep an eye on.
And dividends?
Still no regular dividend, consistent with that growth focus.
Okay, we've looked inside the company. Now let's look outside. How does the market view Stagwell? Who owns it?
Market sentiment.
So market perception. What are the analysts saying?
9 analysts cover them. The overall consensus is a buy.
But how does that break down?
It's interesting. 44% say strong buy, 11% say buy, but a pretty big chunk, 44% say hold.
Almost half are on the fence then. Why do you think that is?
It suggests a nuanced view, right? Maybe caution due to the GAAP losses or worries about the broader industry. It implies a bit of a wait-and-see approach for many.
What about price targets?
The average target is somewhere between $8.04 and $8.50. The full range is wider, from about $6 up to $10.50.
Has recent news moved the needle?
Definitely. Those Q2 earnings beat expectations, and the stock jumped 11% on July 31st. Changes in leadership focused on finance and AI were also seen positively. There was a dip back in June because of some legal investigation news, but the stock bounced back from that. And they've been proactive trying to get advertisers back into news media, tackling brand safety concerns. That shows they're trying to shape the narrative.
Any other market indicators? Short interest. Moving averages.
Short interest is moderate, about 6.6% of the float, around 4.7 days to cover. So some bears out there, but not an overwhelming amount.
And technically.
And the stock's currently trading above both its 50-day and 200-day simple moving averages, 4.948 cents and 4.645 respectively.
Which are generally seen as bullish signals, right? Suggests some positive momentum.
Generally, yes, from a technical standpoint.
Okay, let's shift to who actually owns Stagwell. Who are the major players here?
Ownership structure.
Well, there's significant institutional ownership. 353 institutions hold about 45% of the shares. Big names like Hotchkiss and Wiley, Goldman Sachs, BlackRock, Vanguard, they're all in there.
So the smart money sees some value. That usually adds stability.
It often does, yeah. Indicates professional managers believe in the story, at least to some extent.
What about insiders? Are they aligned with shareholders?
Insiders own a huge amount, 436 million shares collectively. CEO Mark Penn has a big stake, over 31 million shares, that's nearly 12%. Director Eli Samaha has over 8 million, about 3%.
Then isn't there one really dominant shareholder?
Ah, yes. Now, this is really something. Stephen Ballmer.
Yeah?
Yes, that's Stephen Ballmer, Microsoft co-founder. He holds a massive 116 million shares. As of April 25, that was 43.5% of the entire company.
Wow, 43.5%. That's incredibly concentrated. So his view heavily influences things.
Absolutely. Key decisions are definitely shaped by these few very large shareholders. That's critical for any investor to understand.
Have insiders been buying or selling recently?
There have been some non-open market acquisitions by directors, often related to compensation plans. But importantly, there were open market purchases by both Mark Penn and Eli Samaha back in May and June. That's usually a strong signal of confidence. Penn did have a large non-open market disposal recently, but again, that's often tied to stock awards or compensation.
So overall, high insider ownership, some recent buying, generally positive signals for alignment.
Generally, yes.
All right, no investment is risk-free. Let's get into the potential downsides. What are the key risks for Stagwell?
Risk assessment.
Okay, let's do a quick SWOT analysis. Strengths, weaknesses, opportunities, threats. Strengths. That integrated agencies network is key. Their focus on innovation, AI, the marketing cloud is a big plus. Strong client relationships shown by that growth in top clients and winning new business. Experienced leadership under Penn. And those cost-saving efforts are tangible.
Okay, the weaknesses. We've touched on some already.
Right. The persistent GAAP net losses are number one. High operating costs. That high debt-to-equity ratio, though they are addressing it. Earnings inconsistency, missing estimates sometimes, and that low current ratio, suggesting potential short-term liquidity pressure.
Makes sense. Opportunities. Where's the upside potential?
Huge potential in emerging tech, especially generative AI. Expanding globally, most revenue is still US-based, so lots of room internationally, riding the wave of digital transformation in the ad industry, and growing that marketing cloud, more high-margin recurring revenue.
And finally, the threats. What could derail things?
Macroeconomic headwinds are a big one. Clients cutting budgets if there's a downturn, intense competition from everyone, legacy players, consultancies, tech giants that need to constantly invest in rapidly changing tech, and of course, data privacy and AI regulations getting tougher.
Let's talk more about those macroeconomic factors. Inflation, interest rates.
Yeah.
How do they directly impact Stagwell?
Well, inflation hits them directly through higher operating costs, but it also hurts their clients if consumer spending power drops, leading to ad budget cuts. Stagwell's own research even found company reputations suffered due to inflation.
And rising interest rates.
Increases borrowing costs for Stagwell and their clients. If clients have less cash flow because debt is more expensive, they might spend less on marketing. It increases the scrutiny on ROI for every ad dollar spent. And then there's specific geopolitical risks, like those U.S. tariffs imposed in 2025.
How do tariffs hit a marketing company?
Indirectly, but significantly. If tariffs raise costs for imported goods and slow down consumer spending, companies dependent on those goods will likely cut their ad budgets. Forecasts actually showed U.S. media ad spend could drop quite a bit under heavy tariffs. We saw companies like Temu and Shein already cutting Google ad spend. Stagwell even mentioned macro noise from tariffs in their Q1 25 call. So it's a direct threat to client ad spending, which hits Stagwell's top line.
Okay, we've covered a massive amount of ground. Business, management, financials, market, risks. Let's try to pull it all together. What's the final verdict?
Conclusion.
All right, synthesizing all this. The bull case for Stagwell rests on its strong digital and AI positioning. They have proprietary tech, good talent, they're winning new business. Cash flow from operations is improving significantly. Management is experienced and seems proactive. High insider ownership is a plus. And analysts are generally positive.
Sounds pretty good, but the bear case.
Equally important. Those persistent GAAP net losses are a major hurdle. The debt level is still relatively high. Earnings haven't been consistent. They're exposed to macroeconomic slowdowns hitting client budgets. Competition is fierce. They need to keep investing heavily in tech. And geopolitical risks like tariffs are real threats.
So valuation-wise, The stock's at $5.67 now, August 8th. Analyst's average target is around $8.04 to $8.50, with the range going from $6 up to $10.50. That raises the question, doesn't it? Is it trading below its potential right now, or are analysts pricing in future improvements that haven't quite happened yet?
It certainly appears to be trading below those average targets, suggesting potential upside. The strategy digital, AI, new business seems sound. Those are strong tailwinds. But, for you as an investor, you have to weigh that against the real financial picture, the gap losses, the debt, the external risks. Getting to consistent gap profitability and lowering that financial risk profile, that's going to be the key thing to watch.
So here's a thought to leave you with. Stagwell's betting big on being this tech-driven challenger fueled by M&A. In such a dynamic industry, what does it really take to break free from that cycle of high investment and finally achieve consistent, sustainable bottom-line profit? And maybe more importantly for you, what are the specific signs you should look for to know when or if that shift is genuinely happening? Something to think about.
And just a reminder, this analysis was generated by an AI system. It's for educational purposes only, not financial advice. Please always do your own research or talk to a qualified financial advisor before making investment decisions.
Thank you so much for joining us on this deep dive. If you found it valuable, please hit that like button and subscribe to Stock Analytics AI on YouTube. Members, remember you can suggest stocks for future deep dives in the comments. We prioritize those. We'll be back soon with another deep dive to help you stay well informed.